According to a recent survey, there are roughly 25 million private companies in the United States and just 4,000 public ones. Today, I want to focus on the 4,000 public companies with you, and even more specifically, the 40 to 50% of them that pay regular dividends to their shareholders. Now, we can all agree that if those figures check out and they're true, rounding to just 1,600 to 2,000 companies paying dividends is far too overwhelming to even think about evaluating all of them. So you can either just buy a dividend ETF for yourself and call it a day, just after committing that you're going to invest every week or every month to ensure that you feed the ROI machine. Or you can bravely and courageously take on the market itself as a dividend investing pioneer to try to build your own portfolio. Now, if this is the approach that you're going to take, I'm going to tell you that you're going to want to be strategical. You also need to know that all 1,600 to 2,000 paying dividend stocks are not necessarily going to be treated equally, or at least they shouldn't. And you should really only focus on the gems and just avoid all the traps. But how exactly do you do it? How do you go about finding your all-in, buy or die, hold on forever, or at least until it makes sense to sell dividend stock? Well, it really all starts with what I frequently talk about here on the channel, your investor profile, which is a culmination of factors like your age, your investment timeline, or how long you can remain in the market, and what exactly your goals are. For example, if you actually want to retire early to live off your dividends, you will definitely need to invest differently than someone who plans to enjoy revenue streams outside the stock market, yet still enjoys freedom by working for themselves and collecting passive income. Of course, with this example, a higher dividend yielding portfolio really matters for the investor who's seeking to actually live off the dividends. But the reason I am here telling you to actually have a quote unquote all-in dividend stock is because you really don't need to hit home runs with every single stock that you invest into, but you do need just one or two, or perhaps a few of them that really drive home some returns for you. And let's be real, as Bill Ackman or any of the other Wall Street sages often tout, there really are never more than just a handful of high-quality, exceptional stock opportunities out there.
Tell us a little about your portfolio. Why so few names? You know, obviously there has been some rumors of the performance up 6% for the first quarter. I know you can't say that's accurate or not accurate. With most of your portfolio up double digits, one down double digits, which we'll talk about. But give us just a take on why so few names, and
so for a bunch of reasons. I mean, I've always had the view that why not own the best 10 or 11 investments as opposed to ideas 12 through 25 or 12 through 100, which is more typical. And I think there are very few great investments at any one time. So the ability to concentrate is an enormously valuable asset of a strategy. The problem with it is it leads to bumpier returns, and it leads to more attention on mistakes or things that aren't going well. I don't know a portfolio manager that doesn't have a stock that's down in his portfolio, right? But you don't read articles about, we're getting an awful lot of attention for a pretty high profile situation that's struggling. But I think there's, it depends on what your business model is. But if you want to make high rates of return over a long period of time, it's hard to do that being very diversified.
This is perhaps what just makes investing fun for every single active investor. Now, I'm going to openly tell you that my all-in dividend stock for the last decade has been none other than Apple, a tech powerhouse which just dominates the industry and continues to prove itself year in and year out. Yes, even when all the naysayers out there keep saying that Apple is dead because they aren't really creating any new revolutionary products. However, someone like myself may argue that that is exactly what keeps them in the palm of your hand, literally, addicted to their devices, as you are not only familiar with each product and you like to buy them just despite no profound changes because you really just like the consistency, which is psychologically exactly what's supposed to happen and works in their favor. Now, having Apple my largest position in my portfolio over the years, I have experienced the wins year in and year out, with Apple appreciating by over 23% this past year, appreciating by almost 250% over the last 5 years, and of course, just delivering through on unthinkable amounts of appreciation since my initial buy-in. Scrolling down here, I want to just have you see this clean income statement with revenue that pours in each and every year, while also Apple continues to boast a very clean balance sheet that's most important here at $364 billion in assets with $308 billion in liabilities. Now, at the time of my investment, I wasn't really thinking much of the dividend, as I was just all about the company itself and fell in love with the products, which I'm going to come back to in a second. But the dividends have been there for me as well. Clicking into Simply Safe Dividends, we can see that Apple delivers through on a 99 safety score with a lower 0.44% dividend yield, thanks to a 15% payout ratio, which aided in this 12-year dividend streak, while Apple continues to jack up the dividend by an average growth rate here of 8% year over year. And rather recently, I have also begun to really focus on and load up on Alphabet, but given it's not my largest holding, my all-in stock, I'm just here to say there is real power in really focusing in on just one or two or a maximum a handful of stocks. You see, my Apple holding has delivered a substantial amount to my portfolio in terms of portfolio total. That's now well over $100,000. That was my initial goal. And if it weren't for getting serious as an investor and focusing on core holdings, I would have never achieved the financial milestones that I actually did, or it just would have taken me much longer. So I will actually only be focusing more and more on fewer holdings, which certainly will require a greater attention to detail and of course more due diligence, but I think it's all worth it. But if you're sitting there thinking, well, how the heck did this guy do it? How did he just pick Apple as his all-in dividend stock? Simple. First and foremost, I loved Apple as a consumer. Their products, I think, are just unmatched. Now, that led me to investigate the actual company itself. And here is where I want to say avoid looking at the share price, at least for now. You see, a company's value is not determined by the share price, but rather the health of the balance sheet, its earnings, its ability to deliver through consistently on sales. But as we saw Apple's balance sheet, it said that at first glance, their assets trump liabilities and their revenue influxes suggest a very healthy opportunity, whereas I'm not the only Joe buying their products. Of course, this is all basic streamlined investing talk, but again, this is just where you want to start. Now, factor in from there your investor profile. Do you need the dividends now? Are you looking to live off the dividends in the near future? Are you in retirement? If so, I'm not sure you want Apple to be as big of a position as I have it in my portfolio. But if not, you have time. And if you can have time and sit comfortably in volatility, Apple or companies like it may be your dividend whale over time. After all, as the saying goes, high risk, high reward. And if you're already chucking the hundreds or thousands of companies that are the no-namers out there, or you're here now just scanning through the companies whose products you're using daily and enjoying, you are more than halfway there to discovering your all-in dividend stock. Now, this all-in dividend stock may change. Matter of fact, over time, it should change based on your investor profile. But like I said, this game of investing really isn't about loading up on dozens of stocks. It's all about uncovering some of the gems out there in the market that will deliver through on market-beating returns. And the more you invest into stocks that deliver through on market-beating returns instead of average returns that just shell out dividends for your own comfort, the better your total return will be, and that's what matters. So you could play it ultra safe by diversifying your portfolio, or you could take on a little bit more risk or uncomfortability, if you will, and build a dividend portfolio comprised of high conviction stocks, just a handful of them, and really reap the treasures of investing with the gifts of dividends all along the way. Now, if you have your all-in dividend stock, I certainly would love to know what stock that is and why. Go ahead and drop that comment down below. If you think that all of this is just absolute bananas and baloney, I would love to know why. So also go ahead and drop your thoughts down below. And if you're looking to actually understand 3 investment concepts that are totally misunderstood by the vast majority of us as investors, go ahead and click into this video right here. But before you do, subscribe, and I'll catch you in the next video.